welcome everybody. My name is Chad Harmon. I'm one of the partners here at A&I Wealth Management. I think we have almost entirely familiar faces here, which is great. It's my pleasure to serve as our MC this afternoon for our fourth quarter market commentary, where we partnered up with Global Partners from a research standpoint. It's going to be really exciting. Looking around the room, this is awesome. We've got a packed house. It's nice to see folks here live and in color. We also have many of you joining online. I'm going to cross off a few housekeeping items here before I introduce our speaker this afternoon. So for those of you joining online, we have made you invisible, and we have also muted you to protect your privacy, but it's not because we don't want to hear from you. I'd love for this to be more of a conversation than a presentation. And so as questions pop up, if you're here in person, write them down on your note sheet. We've saved plenty of time at the end for Q&A. If you're on Zoom, you can use the chat feature, which is in the bottom of your Zoom screen. Just go ahead and type in your note. We'll be able to see it. We'll put you in the queue for the Q&A. So without further ado, let me introduce you to our featured speaker, my partner and our president, Mr. Karl Frank. I've been bragging about Karl now for going on 14 years, and I've probably said more than he cares for me to share with over the years. But what you don't get to see and what you don't get to hear from us all the time is really what goes on behind the scenes. I think these events are great to let you know what we want our clients to be thinking about moving forward. Obviously, with the attendance we've got today, it shows that we've got a lot on our minds, right? We've got questions on the market. We've got an election year. We've got all sorts of crazy stuff going on around the world. And so we've had plenty of bullet points to talk about with our friends. And we're going to touch on a lot of those today. But what I'm most proud of as one of the leaders of our firm is the work that not just Karl and Stacy and myself have done, but all of our advisors, all of our team on our investment committee. In the last year or two, we have spoke either in person or directly on a Zoom call with every single money manager we are using inside your portfolios. It's important to not only see what their marketing teams are putting out, but to really talk to the people pulling the levers behind the scenes and make sure that we're comfortable and confident with the decisions that are being made and how those decisions are being made. And Karl, I think, has traveled from coast to coast, out from California to New York City and across the pond to London and France to talk to our international money managers, and spent not hours but days doing due diligence, really getting comfortable with the team. And I think that insight is invaluable, and you're going to hear a lot of that come off in Karl's presentation here today. So without further ado, our featured speaker, Mr. Karl Frank.
Thank you so much, Chad. That's really kind. Well, what Chad didn't mention are the cities we're going to visit next. That's on his itinerary. Duluth, Topeka, Gary, Indiana. Oh, I'm kidding. Okay, so I'm going to dive into our presentation. We're going to have a good time today. This is interesting to me, so I hope it's interesting to you. If nothing else, enjoy the food. And those of you at home, I hope you're eating as well. I want to start, though, by reminding you of our second opinion service. So what we offer you as a client of ours is a free service you can give your friends and family and associates. They get up to 3 meetings with us free of charge. And so they can come in with any question they have about money. They can come in with questions about investments, like what we'll talk about today. They may have questions about their retirement income plan. They may have questions about Social Security. They may have questions about insurance or annuities or all sorts of things. So be thinking about who you might know who might want to benefit from that. It's a free service we provide. And if you know anybody who could take advantage of it, we would offer it to them free of charge as a service to you. So I hope you take advantage of that. It's one of our most popular things. I'm going to dive right into it. We're going to talk about the market. We're going to talk about the economy. We're going to talk about some forecasts from one of our research partners, Global Partners. And I think what you'll find is a lot of optimism. There are both good news and bad news, but I think you're going to find the preponderance of the news is good, in spite of what you might be coming in here feeling or anything else. Things look pretty good. Oh, and by the way, this 2-factor barcode on the screen, you can scan that and send that to a friend of yours, and they'll learn about our firm very quickly. All right, so this is 2023 in a nutshell. Wow, what a year, and you'll hear me say that more than once. Beginning from left to right, I'll go through the returns for various types of investments over the years. And bonds did very well during the year with 5.5% annual return on average for investment grade bonds, but 13.5% for high yield bonds over the year. And the blue line that you see right beside that are how much of that gain happened in the fourth quarter. More on that in a minute. Equities are in the middle. U.S. large cap S&P 500 actually is off the chart. It gained 26% last year, an amazing year. U.S. smaller cap companies gained 16.9%. Developed international companies gained 18% over the calendar year, and emerging markets 9.8%. Look at the blue lines beside those, and you'll see how much of those gains happen in the fourth quarter. You'll see almost all of the gains for most of these asset classes happen in just a few weeks at the end of the calendar year. So for those of you who don't look all that often, you might look at that calendar year and feel a whole lot better than those of you who look often and you have the same return. Because the more often you looked last year, probably the less good you felt, because for so much of the year, the returns were flat or not great. Until all of a sudden, shazam, the last few weeks of the year, the market shot up. And it's not because these companies suddenly did a better job at the end of the year. They didn't all of a sudden make a whole lot more money or outlook look a whole lot better, because that's the way the market moves. The market moves, and we call it the concentrated nature of gains. You never know in advance when exactly that's going to happen, but it just did happen. And indeed, January started out as a pretty good January too, and now we're in February, which is maybe down a little bit. But the last category here are the alternatives. Now, at the beginning of 2023, many stockbrokers promoted alternative investments, because in 2022, while most of all the other investments you could have your money in declined in value, alternative investments, by and large, made money during that stock market crash. But last year, you can see that the stockbrokers were not exactly accurate. That was the worst returning of the categories. You do know the difference between a stockbroker and an investment advisor, right? The stockbroker definition of a stockbroker is what he did for your friends. He made them broker. So we're going to dive into the equities. This was an amazing year, but it wasn't across the board. 5 companies ended 2023 larger than many countries in the world. This is an astonishing statistic. The 5 largest equities in the U.S. are Alphabet, Amazon, Apple, Microsoft, and NVIDIA. They're 25% of the S&P 500. In other words, they're bigger than the market cap of many countries. In fact, they have the same weighting as the combined weighting of Japan, China, France, and the UK. These 5 companies are worth about half the world or something like that, right? I mean, it's a huge amount of the population of the world. It's the same as these companies. File that under, if something can't go on forever, it won't. Right? You can't continue to expect that what happened last year with these companies growing so quickly is going to continue. So the S&P 500 is dominated by these large cap mega tech companies. You know the definition of the S&P 500, right? S&P stands for Standard and Poor. It's an economist's life in a nutshell. The Magnificent Seven are the same 5 companies plus 2 more, plus Meta and Tesla. These companies grew so quickly last year. That is the reason why the S&P shot through the roof. In fact, if you look at this chart, you'll see the returns on the Magnificent Seven companies, the Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla doubled, more than doubled over those 12 months, where all of the other large cap companies in the U.S. delivered a reasonable return, 15%. So we're comparing apples and apples here. We're comparing huge companies to huge companies, but 7 of them more than doubled. And that's what drove up the returns of the S&P 500. There are the definition of a bull market. It just grew like crazy last year. And it's probably a little bit unreasonable to think that they're going to double again next year, right? You know, the definition of a bull market, it's the random movement in the market that makes an investor feel like a genius. That's what happened last year with the people who bought that stock. So we're not going to just put our money into those equities. In fact, we've talked about 5 companies. We've talked about 7 companies. Let me talk about 10 companies. 1 out of $3 in the S&P 500 is invested in one of the 10 largest companies in the S&P. That means the concentration of the S&P 500 is very high. It's the highest it's been since the 1970s. It's higher than it was in the dot-com technology boom. So it brings back memories the dot-com boom. And shortly thereafter, other companies did a whole lot better than the tech companies did after 1999, 2000, and 2001. So we want to be diverse. We want to be humble. Had we known that these companies would have doubled in value, we still wouldn't have put one out of every $3 you have invested with us in these companies. It's unreasonable to take that kind of risk. You're going to be much more humble and much more diverse. This chart shows the 10 largest stocks. If you look at that, like that's going back to 1972. That's a very long period of time. Buying them now is not the definition of value investing. No. The definition of value investing is buying low and selling lower, but buying low. That was a joke. That was a stupid joke. Value investing hopefully will come back into style, and certainly it makes sense. In fact, after the last time that the market had concentrations like what I just showed you, value investing did way better than just investing in these growth companies that had done really well the period of time before. So these companies grew, they doubled in value. Not only that, their earnings grew, but not nearly as fast as the stock price. So that's called the price earnings ratio. You know, the PE ratio, you know what that is, right? That's what happens to investors when they're wetting their pants looking at their stock portfolio. No, all kidding aside, the PE ratio is the price of a stock per unit of earnings that they're delivering to you, right? So the higher the PE ratio, the more you're willing to pay for that unit of earnings. So right now, the S&P 500, the growth stocks, only the big growth companies, all the other companies that compare with the Mag 7, you pay $19 for every $1 of earnings. That's about a 5% earning that you would get for every dollar you're spending, but not on these Magnificent Seven companies. You're willing to pay 34 times for every $1 of earnings. That's a big dislocation. That's not common. That's very uncommon. Much of the performance of the Mag 7 was driven by what's called multiple expansion, meaning that people just chased that stock. By comparison, the other 493 stocks had a much lower PE, even lower than the 19 you see here. So our researchers at IM Global Partners believe there's opportunities elsewhere, and just common sense tells you that too. That you don't want to just chase last year's winners. You want to be diverse, and there's opportunities in value companies, international companies, etc. So that makes common sense, and we don't, by diverse, predict that this is going to be a market correction. Like I don't think anybody at the research team is saying that, oh, these Magnificent 70s are going to, have a market correction. You know what a market correction is, right? That's what happens to your stocks the day after you buy them. It feels like that sometimes. It's Murphy's Law. So there's opportunities outside the U.S. This is another way to look at the same chart. One in red are all of the U.S. companies. And the big, thick bar shows you the range that the PE ratio usually stays within. You can see it's way out of whack. It's way high for the U.S. companies because relative to the rest of the world, like we saw in that first chart, U.S. companies have gone up in value, largely driven by the Magnificent Seven. All the other places in the world are within or below their normal range. And so for a patient, disciplined investor who does the research and sits back and doesn't pay attention to the daily movement of the market, this is a pretty big opportunity, we believe. And so we think that you're going to find that over the next few years, being invested this way will deliver exceptional returns for you. Now, that's what the analysts at iMGP think, right? And you know the definition of a stock analyst, right? He's the idiot who told you to sell the stock that just went up in value. Another piece of good news are corporate earnings. Corporate earnings are expected to rebound in the year that's coming up. So in the U.S., IM Global Partners expects low single digit or double digit earnings growth is the current consensus forecast for earnings growth. That's the chart on the left-hand side. In the middle, you can see developed international companies have a lower than that, but emerging markets have nearly twice that. Emerging markets have a very high double-digit expected earnings growth on the companies. Ultimately, for a long period of time, it's the earnings that you're buying when you're investing in a company. And so with earnings growth, there's potential exceptional returns. So while economic optimism in China is at an all-time low, and I don't know that anybody's really excited about the political situation in China, on that previous chart, you'll see that it was near its all-time low in price-earnings ratio. There's a lot of risk that you'd be taking in China. In our portfolios, very little. in China, but a lot comparatively than what a lot of people may think outside the U.S. So there's big opportunities, we believe. Our researchers are definitely more excited about that than they have been in years. So that's the way big institutions look at investing. As you know, big institution is just an institutional investor is just, last year's investor who's now in a nut house. So we won't spend a whole lot of time on them. But what we will do is look at the Fed. The Fed is the biggest player in the interest rate environment, and the Fed is the reason, in large part, why 2022 was a tough year for equity investors, and 2023 was a good year, by and large, for equity investors. So this chart has a lot of data on it. Just go column by column. So on the left-hand side there, you'll see the final rate hike. In that column is a month and a year when the Fed stopped raising rates. And the oldest years are at the top, and the most recent years are at the bottom. And you can see the most recent Fed hike rate increase had stopped. But we haven't looked out into the future yet. We haven't lived that long. So every column thereafter going to the right is 3 months, 6 months, 9 months, and a year. So just skip to the year and look at the bottom of the chart. And what you'll find is that when inflation is not elevated, I'm going to talk about inflation here in a minute, the Fed can move to a more accommodative stance, meaning they can goose stock returns. They can lower the rates faster, which has generally been positive for equities. This can be seen in the post-1980s returns where there's a whole lot of green. There's a much shorter time frame between when the Fed stopped raising rates and starts decreasing rates. Most of the negative outcomes happen at the earlier period of time, particularly the 60s and 70s, during a period of larger inflation when the Fed had to raise rates again shortly thereafter. What I'm saying is this is good news, right? We're likely entering a period of time where equity investors will be rewarded for being patient. And inflation is part of it. The good news about inflation jokes, they just grow in value over time. So I'm going to keep going with inflation and tell you that our research partners at IM Global Partners, they expect lower inflation. Historic money supply growth helped fuel inflation most recently, but as it contracts, iMGP expects inflation to decline too. I'll show you a really detailed chart on that in a minute. This chart compares the year-over-year growth of the money supply. So the yellow line is M2. M2 is liquid money. It's everything that's in cash and everything that's in a readily accessible cash account, like a checking or a savings account, current deposits. So as M2 grows, and all the way on the left-hand side is 1991, somewhere around the year Travis Kelce was born. And over to the right is the most recent period of time. And you can see that M2, the yellow line, as it goes up, generally speaking, inflation follows. So follow that and you'll see the blue line start to go up after it. And then as it goes down, maybe it goes down. Most recently, this is the COVID crisis. This is when the Federal Reserve printed money like crazy. You can see it really is off the chart. Like during our lifetime, we've never done what we just did as a Federal Reserve. And you can see that the blue line inflation very quickly followed it. That the more money there is, the bigger the inflation is. Now, for the first time almost in history, we have a contractive Federal Reserve. The yellow line is way down. We're pulling money out of the economy. And for that reason, iMGP predicts that we'll have lower inflation in the future. So that's really good news, right? We've got more reason to believe that inflation will be lower. And that's important because I think that a lot of us feel the opposite. A lot of us still look at the gasoline prices, which might have spiked up $1 in the past few months, or milk prices are still high, and other things, eating out at a restaurant seems high, and then you add the tip button on top of that, and you're like, holy cow, I just spent $50 on fast food or something, right? But the truth is that the forward-looking research looks pretty good. The inflation is likely going to be pretty low, which is also good news for bonds. And it pains me to say it. Those of you who know me know that I love equities, and I put up with bonds. So for those of you whose financial advisor, whose financial planner allow you to be in bonds and not all in equities, I've got 2 good slides for you on bonds. They look really good. It hurts me to say it, but they look good. So let me explain the chart you're looking at. On the bottom, you'll see what the interest rate is that bonds are paying, their current yield. And on the left-hand side, you'll see the average annualized return looking forward for 5 years from there. And you can see it goes from bottom left to top right. So the higher the interest rate that you're going to pay on your bonds today, the more likely you're going to get good returns over the next 5 years from that investment. That's all it's saying. And so the yellow right there is what you're currently getting on your bond portfolio. So it looks really good, right? It's telling you the same advice that, it's not common it's not complicated to use common sense that says, oh, I'm getting good returns on my bonds. Maybe I want to go ahead and invest a little in there. It's, it's like the flight attendant. She gave me the best advice. She said, bye-bye, right? We can buy. Here's the bond yields that you get right now. So the yellow line is what you're getting paid. Many of these investments that you see across the bottom are investments that we're holding here at ANI. So you might have some money in one of these. The yellow line, we show this every year. The yellow line is the most recent yield that you're getting on those portfolios as of the date in the top right-hand corner, which is the end of last year. The two other lines show what the yields were the years before that. In almost every case, you'll see that yellow line is higher or significantly higher than it has been in recent past. So this is good news for your bond yields. You're starting this year, bond investors, with a nice income. It's a pretty good time to be there. And oh, by the way, the Fed might lower interest rates, which would be even better for bond investors. Last year was a dramatic year. Despite massive intra-year volatility, the benchmark 10-year Treasury ended the year where it started. This is what it looked like. This is the calendar year. And this is the yield that you got if you invested in a 10-year Treasury from the Federal Reserve. This is what the Fed is pulling the trigger on. They're raising and lowering rates, and it's affecting the 10-year yield. And you can see, remember from that first slide, the bonds made most of their money at the end of the year. That's because the Fed lowered rates at the end of the year. That's the market actually lowered rates at the end of the year in response to the Fed, predicting the Fed. So the Fed doesn't control interest rates, the market does, but the Fed's the biggest player. That's why we spend so much time, and the news spends so much time, and it's an easier story to tell that Jerome Powell is in charge of this or some other person's in charge of that. It's an easier story for us to digest, but the market is making these decisions. And so the yield, the return that you got on your bonds last year went way up as interest rates went way down. It was a good time to be a bond investor. The Fed, the problem with predicting the Fed is that the Fed doesn't know itself what they're going to do. They'll tell you, I think most recently, that yeah, maybe this calendar year, 24, they're going to lower rates 3 times. They're on track to do that, but they could change their mind. They don't really know what they're going to do next month. They're like a senior in high school. They don't really know. This is like my EKG living with a senior in high school. Right? Animals will tell you. Parents of teenagers will tell you why animals eat their young. Love them. Love them. Great kid. 189 days when he goes to college, I'll love him even more. All right, so the Federal Reserve makes a big impact, right? And it affected our bond yields. The yield curve, though, is the first of the bad news that I want to tell you. So everything I've told you so far is actually really good news, right? That there's huge opportunities in companies other than the 7 which doubled their value last year. That there's great opportunities outside the U.S. That the economy looks really good, that inflation is coming down. There's lots of things to be optimistic about, but this is not one of them. It's called the yield curve. And so let me explain what the yield curve is, because we hear it all the time. On the bottom, you'll see different lengths of time, from 1 month out to 30 years. And on the left-hand side, you'll see the interest rates. And this is referring to the Federal Reserve. So generally speaking, if you're going to buy a bond and wait 30 years to get your money back, you want a higher yield on that because you're taking a lot of risk. They're not going to give you your money for 30 years. If you only have to wait 1 month, it's not a lot of risk. 30 days from now, whoever the person is that you lent the money to is likely to still be there, and they'll pay you 1 month of that annualized rate of return. The exact opposite is the case now, and it has been that way for over a year, almost 2 years. We're coming up on 2 years that the yield curve will be inverted if it stays this way through this year. So what that is telling you is that, yes, the Fed has raised interest rates, and that's why it's gone so high on the short end of the curve, but investors are in charge of the market, not the Fed. And investors think the Fed is about to lower interest rates. And so they're buying up these longer duration investments, thinking that, oh, we can get good returns on these. As the Fed lowers interest rates, these things are going to go up in value. The yield curve is a big predictor, a fairly reliable predictor of a recession, because the main reason the Fed lowers rates is because of a recession. So the yield curve's been predicting a recession like most people on CNBC and all the other places for over a year now. They've been nanny, negative nannies. And the truth is the market's had a great year, like we just talked about. So why has it been so wrong for so long? Well, this is a fascinating chart to me. Bear with me for 3 minutes as I dive into the details. What you're looking at here is the yellow line is the yield curve. So it's the 10-year minus the 1-year. And the horizontal line here is 0. So generally speaking, the yield curve is positive. When that yellow line is below 0, it means the yield curve is negative. You'll see that shortly thereafter, after it goes to 0, there's a big gray bar in almost every single instance except today. Not yet, right? The big gray bar is a recession. So for long periods of time, this goes back to 1962, a fairly good time. There's been a recession after the yield curve has gone negative. That's what it's showing you. The blue line is the reason, according to our research partners at iMGP, why we haven't had one yet, why the yield curve hasn't predicted one. And that's the accommodative stance of the Federal Reserve. That's the amount of money that the Fed has pumped into the economy. It's what's called the real Fed funds rate. It's the rate the Fed pays less inflation. When it's negative, you can see like it was back in the 70s, it postponed a recession, and then we had 2 recessions back to back as the Fed raised rates. Right? This is the end of the Carter year, the beginning of the Reagan year. This is the, oh my gosh, total brain fart. I'm not old enough to have these yet. It's not Alzheimer's, I promise you, but we do have Chad, who's a lot younger than me. Yeah, it's the Paul Volcker recessions. Because Paul Volcker was the treasurer back then, in charge of the Federal Reserve, excuse me, not the treasurer. And Paul Volcker raised rates ruthlessly. Well, that's the period of time that we're in right now. So we've had this massive, massive government printing of money. And so the real Fed funds rate is very low because inflation was high. Remember how inflation was high just a minute ago? We all know that in the real world. And we printed massive amounts of money. But look what's happening now. Right? We've stopped doing that, and it's going way back up. And so they predict a recession. They think, okay, now we're getting restrictive. Now the Fed is getting serious about this. In fact, many people believe if the Fed lowers, like some people say they will, rates by about 0.75% this calendar year, that still will cause a recession. It's not enough. That would just bring us back to 0 right here. So iMGP is a little bit negative. You know, they're forecasters, they're economists. They're just like, they're really bad target shooters, right? The economist goes out into the target shooter and shoots, he's off by 3 feet to the left. And then he goes out and shoots and he's off. The next economist is 3 feet to the right. And the third economist walks up and says, we got it. Because on average, we're right there, right? They don't really know. None of us do. We got to just be a little bit humble. So that's the negative news for the entire presentation right there, that they're predicting a recession, but they're also predicting a very mild recession and probably very short recession. And if you look at this chart, even a long recession is very short for the duration of our lives. Recessions are rare, they're short-lived, and this one will be particularly mild according to that research team. Done your questions. Coming to the end. Okay, here we go. So that's one research team, but we don't just use them. We're a little humble. We want to use more than one. So we got this other team, and the other team does a really nice job of summarizing it all in a few graphs. And you can go to their website, Athena Invest, anytime and see what they're thinking about the world right now. And so Athena Invest is our second research partner. They're based here in Colorado, and they have 4 different categories of looking at the future. And the first one is what they got their patent on. It's called the behavioral research. So the behavioral research is in green. It's positive, if you can read that. And largely, they're looking at all of the behavior of investors, and they've got their own research that they do. And they say, well, right now, it's a good time to be an equity investor. It looks pretty good, with the exception of those magnificent 7 companies that doubled in value last year, but whose earnings did not double. You know, investors look excellent or positive. That's excellent is as good as it gets. I don't know that I've seen it excellent very often at all. The second category are the economic indicators. And these two, the goods activity and the service activity, are academically favored and statistically reliable measures of predicting the economy. So we can tell you what those are afterwards if you're really interested in what they are. But they're kind of, you know, a little bit of caution. The economy, like we were talking about earlier, is not looking all that great according to those 2 predictors of goods activities and service activities. So we're mixed, right? One really good, one really bad. The third one is valuation. And of course, that's caution. Like we were talking about before, these magnificent 7 companies are through the roof. And so people are willing to pay more for that PE ratio. They're willing to pay a lot more last year for these big technology companies, probably their worth. So the PE ratio is exercising caution. It's not like the danger zone, but, you know, be careful. And then the third one is positive. And the third one's technical indicators. And so this would be like a momentum investor. You know what a momentum investor is, right? It's an investor who buys high and tries to sell higher. It's really just kind of a fad is what it is. So you're mixed, right? You've got two really good ones, two caution ones. The Athena Investment Market Barometer is not nearly as bearish, I would say, as the iMGP is predicting a minor short recession. But it's not necessarily a bear market either. Recessions can come and go, and your equities can still do well. In fact, we just had one of those. We just had a bear market without a recession in 2022. So what happens after a bear market? Well, here are 10 of them. Historically, market declines are followed by market strength and typically grow stronger as time passes. So pick any one of the 10, and they're all greater than a 20% decline in the market. So the first one there, minus 21%. 10 years later, the gold bar, S&P 500 was up 136%. You can see that 10 years later, it's been as high as 263% after a 21% decline, 234% after a 33% decline. It comes back. And you never know exactly how quickly it's going to come back because all the other bars, the 3 years, the 5 years, in between the two of them, it could be negative still, or they could be coming back quickly. That's the concentrated nature of gains. So, note that the 5 and 10-year performance shown in the chart overlap. But the results reflect what an investor would have actually received had they started investing at the end of, say, August 1987, right? Or at the end of February 20. This is what your actual S&P returns would have delivered you. So a bear market, in case you don't know, is a 6 to 18-month period. The kids don't get an allowance, the wife doesn't get any jewelry, and the father doesn't get any sex. So glad you were here for that. All right, summary. So in conclusion, 2022 was a bad year, and we're still digging our way out. The S&P, the NASDAQ, and the Dow were down 21, 25, and 35% respectively. But last year, at some point in time, most recently, all of them are at or near all-time highs. So it's coming back. Right? 2022 was a tough year. It was a busy year. It was a dramatic year. And this year is also going to be a busy year. So a couple of weeks ago, we gave a presentation on investing in an election year. You can scan the barcode on here and watch the recording, or just visit our website. You just go to assetsandincome.com and then click resources, videos, and you'll see that. Or view my account, you'll see the video pop up there too. And learn about a guide that we can give you for investing in an election year. If you'd like, people who are here, I think we have a few of the printed copies. We can give you those too. So next event is February 13th. It's our mobile blood drive. Make sure to sign up for that if you haven't already. I think we might be sold out though. So we'll do this again in 6 months. Thank you so much for the clients and friends who are joining us for the mobile blood drive. In March, we'll have another event. We're going to have one on completely different topic, not investment related. It's going to be on creating an elder plan. And this, I think, will be our #1 initiative here at A&I Wealth Management, is to help everybody age the way that they want to age. And it's a powerful 10-week training that I went through last week. Our team is going through a 4-week training right now. And so we'll be able to deliver this to you in March. I think you'll really enjoy that initial presentation. Our speaker will join me. She's the one of the nation's experts on this. And we can ask her all sorts of questions. I think you'll find it enlightening and heartfelt as well. So that concludes our investment presentation for today, and we are open for questions. Thank you so much for listening. Appreciate it.
All right.